Russian President Vladimir Putin has ordered troops to enter two separatist regions in eastern Ukraine. He's calling it a peacekeeping mission after he recognized Donetsk and Luhansk as independent. Hours after Putin's order, an unmarked military convoy was seen on the outskirts of Donetsk. The United States has called Putin's claim of troops being used as peacekeepers nonsense and warned of dire consequences for Ukraine, Europe, and the world should Russia launch a full-fledged invasion.
In the early morning hours of February 24, 2022, predictions of a full-scale Russian invasion of Ukraine came true. According to U.S. sources, Russia has amassed up to 190,000 troops on Ukraine's borders over the course of several months. The military buildup near Russia's neighbor and former Soviet Union state began in late 2021 and accelerated this year. We'll see in detail how the Russian invasion of Ukraine is affecting the stock market in this video. But first, if this is your first visit to our Smart Stocks Academy channel, please accept my warmest greetings. Hit the like button, subscribe, and click the notification bell next to it to be the first to know when a new video like this is released. So if you're ready, let's get to the video. The Russian currency fell to new lows as global equities fell and oil prices rose as the West stepped up sanctions against Moscow in response to its invasion of Ukraine, including banning Russian banks from using SWIFT global payment system. To support the ruble and combat inflation, Russia's central bank raised its benchmark interest rate to 20% from 9.5% and imposed some capital controls. As the ruble fell by as much as 32%, authorities compelled exporting enterprises to sell 80% of their international revenues before recouping some losses. According to the European Central Bank, the European arm of Russia's largest lender, Sberbank, is on the verge of failing, signaling the start of a looming economic crisis in the country.
And the West is trying to isolate Russia economically. Now, several European subsidiaries of Sberbank Russia, which is majority owned by Russian government, is failing for or likely to fail due to reputational costs of war in Ukraine.
Sber Europe AG, which had a total assets of 13.64 billion euros or $15.3 billion at the end of last year, as well as its Croatian and Slovenian subsidiaries, has been a significant outflow of deposits in recent days and is likely to default on its debts and other obligations, according to the ECB. The European Union Single Resolution Board has imposed a payment moratorium at the three banks and will now review whether saving the institution was in public interest. As a result of the reputational impact of geopolitical tensions, Sberbank Europe AG and its subsidiaries saw considerable deposit withdrawals, the ECB stated in a statement. As a result, its liquidity position deteriorated, the ECB added. At group level, and in each of its subsidiaries within the banking union, there are no feasible remedies with a realistic probability of recovering this position. Outside Europe's financial union, Sberbank Europe AG has subsidiaries in Hungary, the Czech Republic, Serbia, and Bosnia and Herzegovina. The bank has contacted local supervisors because these are outside the ECB's jurisdiction. In the European Union, retail depositors are insured up to 100,000 euros per bank. Outside of Russia, the effect of tougher sanctions were felt in financial markets, particularly in Europe, where the main German and French stock exchanges fell more than 3% in early trade before recovering most of their losses. Other European banks were also heavily hit, with those most exposed to Russia, such as Austria's Raiffeisen Bank, UniCredit, and Societe Generale, losing 9.5% to 14% of their value. The wider Eurozone index, which includes 22 big banks, fell 5.7%, although the Pan-Regional Stock 600 stock index fell only 0.09% as sentiment improved after the closing. However, talks on a ceasefire fell short of a resolution, with a member of the Ukrainian delegation claiming that the discussions were tough because the Russian side was biased. news that dampened Wall Street's mood. The Dow Jones Industrial Average fell 0.49%, while the S&P 500 index fell 0.25%. The Nasdaq Composite rose 0.41% on expectations that the Federal Reserve would be less aggressive in raising interest rates. The MSCI All Country World Index stock fell 0.077% at the close. Markets are expected to remain bumpy in the foreseeable future, according to analysts. In a note to clients, Solita Marcelli said that while valuations have decreased and some risks have been priced into the market, it is not time to de-risk. Investors seeking to trade off geopolitical developments might easily get whipsawed, Marcelli added, noting that geopolitical sell-offs have historically been limited. Oil prices soared after Russian President Vladimir Putin declared a posture of nuclear war on his country's nuclear forces on Sunday.
Top officials of leading NATO countries are making aggressive statements about our country. Therefore, I'm ordering the Minister of Defense and the Chief of the General Staff to put the strategic nuclear forces on special alert.
Fears that oil supplies from the world's second largest producer could be affected increased as tension rose, driving Brent crude prices up to $3.06 to $100.99 a barrel. After reaching $100 this week, US oil closed up 4.5% at $95.72 per barrel, its best level since 2014. The White House stated that limits on US purchases of Russian oil and gas have not been ruled out. According to economists, the global economy is facing considerable economic and financial turbulence in Russia, the world's 11th largest economy, which will flow across its borders. Markets must digest the disturbance to hedging contracts, insurance coverage, and energy markets, even if Western governments approve the purchase of oil and gas from Russia, according to Christopher Smart, Chief Global Strategist at Barings Investment Institute. Will the Russian government enable foreign loans to be paid if Russian firms are effectively barred from exchanging their money to the world's reserve currencies? He asked. As market volatility persisted, investors sought refuge in the dollar, Swiss franc, and Japanese yen. The euro declined by 0.48% to 1.1213 per dollar, while the Japanese yen rose 0.55% to 114.92. The ruble dropped to 101.40, down nearly 20% on that day. Government debt, such as that of the United States, is a good example. Treasuries and German bonds, which are among the safest investments in the world, were in high demand. The 10-year Treasury yield dropped by 15.6 basis points to 1.828%, down from more than 2% on Friday, while German yields declined 4.7 basis points to 0.109%. Money markets have pushed back rate rise forecasts, with investors now expecting the European Central Bank to tighten by 30 basis points this year, down from 35 BPS late last week, and as much as 50 BPS just a couple of weeks ago. It is rational for curves to reduce the possibility of rate hikes in Europe and the United States, said Antoine Bouvet, senior rates strategist at ING. While it is too early to judge the economic impact of the current crisis, we do know that it will have a negative influence on growth. We just don't know how much. A meeting of the Bank of Canada on Wednesday could be a barometer of how Western central banks are judging the impact of Russia's onslaught on Ukraine on their economic and inflation prospects. The Bank of Canada is largely expected to raise interest rates by 25 basis points, the first increase since October 2018, with just over 6 rate hikes priced in by year's end. In March, the Bank of England is projected to raise rates by 25 basis points. However, bets on a more aggressive boost to 50 basis points have faded. According to sources familiar with the situation, ECB chief economist Philip Lane has informed other policymakers that the Ukraine crisis might lower the Eurozone's economic output by 0.3% to 0.4% this year. it becomes very difficult for them to navigate, especially the ECB, said Salman Ahmed, global head of macro at Fidelity International. For the Feds, this will be more of an inflation issue than a growth issue, so they will continue to tighten. Maybe not 50 basis points, but 25 basis points. They don't want to be the source of theatrics in this environment. Bitcoin has also increased by 10.43%, $41,645.99. Gold futures in the United States rose by 0.7% to $1,900.70 an ounce. Palladium prices, which are used in catalytic converters, increased 5.1% to $2,488.20. Nornickel of Russia is the world's largest palladium supplier. As investors fled Russian assets, MSCI's Russia Equity Index fell 25.5%, while London and Frankfurt listed Russian equities exchange-traded funds fell 37% to 53%. While it is impossible to anticipate what will happen next, how do you think this battle will affect global markets and the economy in the future? And how are you preparing your portfolio? Please let us know what you think in the comments down below. And with that, today's video comes to an end. If you haven't already, hit the like button below to show your love and support for this video. Also, don't forget to subscribe to the channel and click the notification bell right next to it to be the first to know when a new video like this is released. Thank you for taking the time to watch, and we hope you learned something. We'll see you on the next video.